Okay, so today we're going to deep dive into a company that's trying to, well, they're trying to like totally change how real estate works.
Mm-hmm.
And, maybe they're onto something, maybe they're not. We'll see.
Yeah.
This company's Opendoor, and their whole thing is they buy homes.
With cash?
With cash directly, and then they resell them for a profit, hopefully.
Right.
And for anyone who's ever, been through the whole rigmarole of selling a house, you can see how this could be appealing, right?
Well, absolutely. I mean, who wants to deal with open houses and, all the negotiations and the waiting? And...
Yeah, all that stuff. So,
Yeah.
Opendoor wants to kind of cut through all that.
Make it simple.
Yeah, make it simple. And they're not, this isn't some small operation. They're actually in 50 markets across the U.S.
That's right. Yeah. They got a big footprint.
Huge footprint. And they have a lot of properties on their hands right now.
They do. They do.
And that brings us to the article that we're going to be looking at today, which is from The Motley Fool, published on April 7th, 2025. And the big question that this article brings up is, Opendoor is sitting on $2.2 billion worth of homes that they haven't sold yet.
Yeah.
So is that a huge problem?
Yeah.
Or is that a massive opportunity?
A really interesting question.
Yeah.
Because on the one hand, you've got, all this inventory just sitting there.
Yeah.
But on the other hand, if they can time the market right and unload those properties when demand is high,
Yeah.
it could be a huge win.
It could be a windfall, right? So let's unpack this a little bit. So $2.2 billion in homes.
Yeah.
That's a big number. But what does that actually translate to in terms of like number of properties?
So as of the end of last year, that $2.2 billion worth of homes represented 6,417 individual properties.
Wow.
Yeah, it's a lot of houses.
That's a lot of houses to be just sitting on.
It is. And what's even more interesting is the rate at which that inventory has been growing.
Oh, really?
Yeah. So compared to the end of 2023, their inventory has increased by 22% year over year.
Wow, that's substantial.
It is. It's a big jump.
So I think one of the first things we need to just acknowledge is the sheer scale of this $2.2 billion worth of inventory.
There's a lot of capital tied up.
Yeah, and the article mentions that Opendoor is, they're not exactly in the black right now.
Right, yeah. They're described as bleeding red ink at the moment.
Yeah, so that obviously adds another layer of, I guess...
Concern.
Yeah, when you have that much money just sitting there.
Absolutely. I mean, for any company to have that much capital tied up in assets that aren't generating revenue is a risky position to be in. For sure.
But here's where it gets interesting to me is it seems like Opendoor isn't just, randomly buying up houses.
Oh.
They have a strategy in place.
They do. They've got a very deliberate strategy when it comes to buying and selling these homes.
So tell me about that.
So their strategy revolves around what they call the off-season and the on-season.
Okay, I like this.
So the off-season for them is the fourth and first quarters of the year, and that's when they really ramp up their buying activity.
Oh, interesting.
And then the on-season is the second and third quarters, which is, typically when the real estate market is the most active.
Right, spring and summer.
Exactly.
Yeah.
And that's when they aim to sell off a lot of that inventory that they accumulated during the off-season.
So it kind of makes sense when you think about it, like the natural ebbs and flows of the real estate market.
Absolutely. They're trying to work with those natural cycles.
Yeah, buy low, sell high, essentially, right?
Exactly. Capitalize on those typical seasonal price swings.
So what's the thinking behind that strategy? Like, what are they hoping to achieve by doing it this way?
Well, there are a couple of intended benefits that they're hoping to capitalize on.
Okay.
The first one is by concentrating their buying during the off-season, they're hoping to get better prices.
Oh, okay.
Because there's less competition from other buyers during those slower periods.
Makes sense. Less demand should theoretically lead to lower prices.
Right. Okay. And then the second benefit is that by focusing their sales efforts during those peak months of the on-season, the second and third quarters, they're hoping to fetch higher prices because that's when buyer demand is typically at its highest.
Okay, yeah, that tracks, like simple supply and demand.
Exactly.
So, if they can buy low during the off-season and then sell high during the on-season, that's the dream, right?
It is. And the article actually quotes Opendoor as saying that this approach should enable it to better capitalize on typical seasonal price swings and maximize value in every transaction.
Well, that sounds good.
It does sound good on paper.
Yeah, on paper. So what's the catch?
Well, as with any strategy, there are always risks involved.
Yeah, nothing's ever perfect.
Right. And the inherent risk with this approach is that The homes that they acquire during the off-season are going to be sitting on their balance sheet for a longer period of time.
Oh, I see, because they have to wait for the on-season to roll around to really try to sell them.
Exactly, and that extended holding period means they're incurring costs.
Right. You've got property taxes, you've got maintenance potentially, you know?
Absolutely. All those things add up, and then there's the opportunity cost of having all that capital tied up.
Yeah, that's a good point.
Yeah.
That money could be being used for other things.
Exactly. So the longer those homes sit unsold, the more that risk grows.
And the article brings up a statistic that kind of highlights this risk.
Yeah, it does. It says that the percentage of Opendoor's inventory that's been on the market for over 120 days increased significantly from 23% at the end of the third quarter of 2024 to 46% by the end of the following quarter.
Wow, 46%. So almost half of their inventory has been sitting there for over 4 months.
Exactly. And that's a red flag for investors because it suggests that maybe their timing strategy isn't working as well as they hoped.
Yeah, I mean, that's a lot of homes that are just lingering.
It is. And it's important to remember that the real estate market is not always predictable.
Oh, absolutely.
Things can change very quickly. Interest rates can go up. The economy can slow down. And suddenly those homes that they were hoping to sell quickly become a lot harder to unload.
Yeah, and the article actually says it's too early to know if Opendoor's timing strategy will work out as planned.
Right.
So there's a lot of uncertainty there.
There is a lot of uncertainty, and that uncertainty makes this a risky investment.
Okay, so we've got this timing strategy, and we've got all these homes sitting on their balance sheet. But there's also the bigger picture to consider.
Oh, absolutely.
Yeah.
We can't ignore the macroeconomic environment.
Yeah, the article mentions macroeconomic uncertainty.
Right, and that's a huge factor because the real estate market is very sensitive to things like interest rates, inflation, and overall economic growth.
For sure. If the economy takes a downturn, people are less likely to buy houses.
Exactly. And if interest rates rise, borrowing becomes more expensive, which also cools down the market.
Yeah, so all of these external factors can really throw a wrench in Opendoor's plans.
Absolutely. And
Yeah.
the article raises a very important point. It says, if the upcoming selling season doesn't go well, Opendoor's model may prove to be unsustainable.
Unsustainable. That's a strong word.
It's a warning sign that their whole business model could be at risk if they can't sell these homes.
And, it's not like this is uncharted territory. Other companies have tried this before.
That's right. The article mentions Zillow.
Yeah, Zillow. They were big in the real estate space.
Huge. They had tons of data. They had all the resources, but they ultimately decided to exit this business of buying and selling homes directly.
Yeah, they couldn't make it work.
And that's a cautionary tale for Opendoor because it shows that even with all the data and the technology, this is a really difficult business to succeed in.
Yeah, it's a tough nut to crack.
It is.
So we've got this massive inventory, $2.2 billion worth of homes.
Mm-hmm.
We've got this timing strategy that they're betting on.
Yeah.
And we've got this macroeconomic uncertainty looming over everything.
Right.
So it's kind of like, two sides of the same coin, right? On the one hand, if everything goes perfectly, if the market cooperates, if their strategy works out, this could be a huge win for Opendoor.
Yeah, they could unload all those homes at a profit and really prove that their model is viable.
Yeah, but on the other hand, if things go south, if the market takes a dip, if those homes keep sitting on their balance sheet, this could be a disaster.
Absolutely. It could put their entire business in jeopardy.
Yeah. So what do you think, as an observer of the real estate market, what are some of the key factors that are going to determine whether Opendoor sinks or swims?
Well, I think one of the most important things to watch is going to be how quickly they can sell those homes that are already in their inventory.
Okay.
If we start to see that inventory age continue to increase, that's a bad sign because it means they're having trouble moving those properties.
Right. And that could lead to them having to lower prices to get rid of them, which would obviously cut into their profits.
Exactly.
Okay. So
Yeah.
inventory age, that's one thing to watch. What else?
I think another crucial factor is going to be the overall health of the real estate market.
Well, of course. Yeah.
If we see interest rates start to rise significantly, or if there are any other economic shocks that could really dampen buyer demand, and that would make it much harder for Opendoor to sell their homes.
So it's really a combination of their own operational execution
Right.
and the broader market conditions.
Exactly. Both of those things have to align for them to be successful.
So let's just recap quickly for our listeners here.
Okay.
Opendoor is trying to simplify home selling by acting as a direct buyer.
Yeah, cut out the middleman.
Yeah, they've built up a huge inventory of homes, $2.2 billion worth.
As of the end of last year.
Yep, they're using this seasonal timing strategy to try to buy low and sell high. But there are risks involved.
Yeah.
Those homes could sit on their balance sheet for a while.
Right.
And the macroeconomic environment is unpredictable.
Very unpredictable.
And we can't forget that other companies have tried this and failed.
Yeah. Zillow is a prime example.
So it all boils down to this question. Does Opendoor's $2.2 billion in unsold homes represent a major problem or a substantial opportunity?
And the answer is it's really too early to tell.
Yeah, it's going to depend on a lot of factors.
A lot of factors both within their control and outside of their control.
And that brings us to our final thought for today.
Okay.
We've talked about the data on Opendoor's inventory and the challenges they're facing.
Mm-hmm.
But we want to hear from you. What do you think are the most crucial factors that will ultimately determine whether Opendoor succeeds or fails?
Yeah, what are the make or break points that you're going to be watching?
Exactly, because it's a fascinating case study.
It is.
And there's a lot at stake.
A lot at stake for Opendoor and for the future of real estate as a whole.
So let us know your thoughts, and until next time, happy investing.
Happy investing.